Here's a name most investors scroll past: Indutrade. But Insightful Value noticed something different. The stock price looks beaten down, but under the surface, this might be a stealthy compounder waiting for a bounce. This review is for informational and educational purposes only, not financial advice. Hit subscribe and like this video if you want more real value analysis without the fluff. Indutrade is a Swedish industrial group that acquires and develops tech-driven companies in niche markets. They operate over 200 companies in areas like flow technology, industrial components, measurement and control, medical solutions, and more. The strategy? Decentralized growth. Let the acquired companies thrive with autonomy, while Indutrade supports them on the strategic and capital side. This buy and build model has worked consistently until the recent slowdown. In 2024, Indutrade reported net sales of around 28 billion Swedish kroner, with an organic growth rate of 1% and operating profit of 3.6 billion. Operating margin stood strong at 12.9%, despite some cyclical headwinds in sectors like precision tools and industrial automation. Earnings per share landed at 8.82 Swedish kroner, and return on capital employed was a healthy 19%. The dividend was raised again to 2.60 Swedish kroner per share, continuing their streak of annual increases for over a decade. So why is the stock down? In 2025, organic growth has slowed further, particularly in manufacturing-heavy segments. Short-term demand weakness and customer destocking are pressuring order flow. Also, Indutrade tends to trade at high multiples due to its acquisition track record. When momentum fades, the stock derates quickly. Add in concerns about inflation and interest rates weighing on margins and financing costs, and you get the recent dip in valuation. From a value investing perspective, Indutrade checks many boxes: high returns on capital, strong free cash flow, and a long runway for growth via disciplined acquisitions. It also runs with low net debt relative to EBITDA, giving it flexibility. The dividend yield sits modestly around 2%, but the consistency and steady growth give confidence. Margins have held up better than peers, and the decentralized structure means less risk of bloated central costs. However, there are risks. Acquisition quality is critical. Overpaying or poor integration could erode returns. Also, many of its end markets are cyclical. If industrial demand weakens further, earnings may continue to stagnate. FX fluctuations and geopolitical tensions in supply chains can impact input costs and delivery reliability. So why consider Indutrade now? The valuation has come down from historically high levels. If the market is overreacting to short-term noise, this could be a strong re-entry point for long-term investors. Why hold off? If you believe the industrial cycle will worsen or acquisition opportunities will dry up, you might want to wait for more clarity. The dividend has steadily climbed from 1.20 Swedish kroner in 2015 to 2.60 Swedish kroner in 2024, signaling long-term confidence. The company also continues to pursue bolt-on deals even in this environment, signaling management still sees growth potential ahead. As for recovery chances, much depends on sentiment and sector rotation. But structurally, Indutrade remains strong and could surprise to the upside if demand stabilizes and margins remain intact. At Insightful Value, we break down complex fundamentals and help you find underappreciated opportunities, like this one. Whether you're just starting out or are deep into your value investing journey, you'll find plenty of sharp takes without the jargon at insightfulvalue.com. Subscribe to the channel for more deep dives and visit insightfulvalue.com for detailed breakdowns and fresh investment ideas.